They said it would never happen. Imagine paying for your American dream home with a virtual currency that does not even rattle like pocket change. And yet, here we are in a reality that is stranger than the grandest fiction. The Federal Housing Finance Agency has just directed two of the biggest players in the United States mortgage world, Fannie Mae and Freddie Mac, to treat cryptocurrencies as viable assets for single-family mortgage loans. Sounds shocking enough, right? We are about to dive deep into this unexpected policy pivot and find out what it might mean for homeowners, investors, and every curious onlooker in between. How did this groundbreaking declaration come about? What does it imply for the future of housing? And where does the excitement and risk truly lie? In this episode, we will uncover all these layers and more, from the subprime crisis that nearly destroyed the global economy to President Trump's ambitious push for all things crypto, and why the new Federal Housing Finance Agency directive could turn the mortgage landscape on its head. But before we get too far ahead of ourselves, let us set the stage. Fannie Mae and Freddie Mac are the giants who stand at the heart of the American housing market. If you have ever taken out a conventional mortgage loan in the United States, chances are one of these two enterprises was looking over your shoulder, guaranteeing the debt or packaging it into mortgage-backed securities. They have shaped and stabilized the lending environment for decades, especially since they fell under conservatorship in 2008 when the housing bubble burst and ignited a worldwide financial meltdown. This meltdown was so catastrophic that it forced the United States government to step in, placing Fannie Mae and Freddie Mac under the supervision of the Federal Housing Finance Agency. Ever since, these mortgage behemoths have been closely monitored and regulated, ensuring they walk a prudent path after the fiasco that nearly toppled the global economy. That is why the mere whisper that Fannie Mae and Freddie Mac might start considering cryptocurrencies, digital assets often regarded with suspicion or confusion, as acceptable reserves for mortgage loan risk assessments, is jaw-dropping. Federal Housing Finance Agency Director William Pulte, who made this statement with a flourish on social media, announced it in a way that demanded attention. Tying the measure closely to President Trump's vision of making the United States a crypto capital of the world, Pulte has effectively told Fannie Mae and Freddie Mac, prepare your business models to count cryptocurrency assets just like cash, as long as they are stored and validated within United States regulated centralized exchanges. That last bit is critical, as it places a framework of accountability around these digital coins. If you think this is just bureaucratic chatter, think again. The potential ramifications are enormous. Today, more than half of the American mortgages in circulation carry the guarantee of Fannie Mae or Freddie Mac. They have a massive role in making homeownership accessible and shaping interest rates for millions. To incorporate cryptocurrency holdings into the risk assessments, especially without forcing a conversion into United States dollars first, practically grants digital assets a stamp of mortgage-worthy reliability. Now, the question that leaps out is whether this bold move will open doors or simply court danger. Cryptocurrency swings in value with dizzying volatility, so does counting it as a stable mortgage reserve actually make economic sense? Or is it an ingenious method to attract more people into a maturing digital currency ecosystem? If you are intrigued already, give us a quick nudge of appreciation, because everything we unravel from here on out could reshape the housing game for decades to come. Let us roll back the clock to 2008. The global financial system found itself standing on a precariously tall tower made up of mortgage-backed securities held together by questionable lending practices. A wave of mortgage defaults finally crashed that tower, upending major banks and leaving millions of Americans evicted from their homes. Fannie Mae and Freddie Mac, which had guaranteed countless loans, were suddenly teetering on the brink of insolvency. Amid the chaos, the Federal Housing Finance Agency swooped in and placed the two mortgage giants into conservatorship. Ever since, each year they have had to present thorough analyses demonstrating that their financial safety is up to par, that their risk assessment is watertight, and that they adhere carefully to the mission of making housing accessible across the nation. Yet, the environment has not stood still. Digital money, once a mere fringe concept, has exploded into the mainstream. Bitcoin, Ethereum, and a host of other cryptocurrencies are no longer curiosities. They have become major discussion points for investors, governments, and average citizens eager to diversify portfolios. Cue to President Trump's more recent inclination toward digital assets. Before the housing meltdown, few could have envisioned a scenario where the White House would push for a national Bitcoin reserve, or a digital asset stockpile, or the notion that mortgage giants and conservatorship might soon count cryptocurrency as capital. But as time has shown, the improbable can become reality in the blink of an eye. Trump's second term, as some have observed, featured a surprising shift. He recognized the cultural momentum behind the cryptocurrency sphere, the excitement, the possibility of bypassing certain financial constraints, and the global race to become the premier hub for digital asset innovation. In an increasingly competitive world, holding a leadership position in technology and finance seemed like a make-or-break proposition for the country. So the White House, under President Trump, began releasing executive orders that seemed ripped from the pages of a science fiction novel. Among them, one establishing a strategic Bitcoin reserve intended to store digital wealth at a national scale. Then came a $2.5 billion deal with institutional investors to build up a Bitcoin treasury, forging a bold path no one saw coming just a few years earlier. Vice President J.D. Vance, in the midst of this social and financial ferment, made his own cameo at the Bitcoin 2025 conference in Las Vegas. Standing before a buzzing crowd, he signaled that this administration was wholly committed to the cryptocurrency cause. He spoke of digital assets not only as a potential investment or technological marvel, but also as a testament to personal liberty and the free exchange of value. That message resonated strongly with countless attendees, who felt validated by seeing that top national leaders not only acknowledged the crypto revolution, but embraced it as a cornerstone of economic progress. That moment truly underscored the dramatic shift in sentiment from the early days of cryptocurrency, once overshadowed by skepticism, to a new phase where digital coins might be hailed as an essential financial instrument. And then, just as we all started to adjust to that revelation, the Federal Housing Finance Agency directive dropped its bombshell. Turn your heads, Fannie Mae and Freddie Mac, and incorporate crypto into your frameworks. It sounds exciting, but let us slice open the complexity. Cryptocurrencies, by their continental leaps in valuation, present an undeniable conundrum in risk assessment. On Monday, your digital wallet might hold $20,000 worth of Bitcoin, only to plunge to $10,000 by Wednesday. Longtime market observers have lived through numerous cycles of boom and bust. So, the question arises, how will an entity like Fannie Mae or Freddie Mac, historically allergic to unpredictable debts, manage to incorporate such unpredictability into its underwriting requirements and risk management systems? The Federal Housing Finance Agency's directive states that only cryptocurrencies stored on United States regulated exchanges count. This detail is paramount because it implies a stronger emphasis on transparency and compliance, and potentially a reduced risk of dealing with unverified or obscure assets. The directive aims to walk that fine line. It opens the door to new wealth channels, but under carefully measured conditions, hoping that any major volatility gets tamed by oversight. Moreover, the Federal Housing Finance Agency expects Fannie Mae and Freddie Mac to prepare a formal proposal on how exactly they plan to integrate these new digital reserves. That means thorough guidelines on verifying ownership, tracking values, and safeguarding the assets. They presumably need to outline the scenarios in which a borrower may rely on cryptocurrency for down payments or to show adequate reserves, and how these assets can be quickly liquidated if the borrower encounters difficulty making monthly payments. The scope here is monumental. If Fannie Mae and Freddie Mac can figure out a robust system to incorporate cryptocurrency holdings, that achievement could signal a watershed moment across financial markets worldwide. It might encourage banks, credit unions, and other lending institutions to adopt a more welcoming stance toward digital assets, effectively weaving cryptocurrency deeper into mainstream finance. At the same time, cynics believe it might expand the risk factors that lead to defaults, reminiscent of the subprime fiasco, if not handled prudently. So, how does this tie back to everyday people who might be looking to buy their first home, refinance an existing property, or simply keep tabs on the housing market? Imagine you are a young entrepreneur with considerable cryptocurrency investments, but limited cash in a traditional checking account. In yesterday's world, you might have struggled to meet certain mortgage requirements because your assets were not denominated in United States dollars. But under this new directive, if the plan goes through, your digital coin stash could serve as the proof of reserves needed to qualify for a mortgage, as long as you store those assets in a regulated exchange. This approach could effectively expand homeownership to individuals who have built wealth in non-traditional ways. On the flip side, It also raises the specter of borrowers with large but potentially unstable cryptocurrency balances, who might find themselves in trouble if a market crash suddenly halves the value of their holdings. Would they default in larger numbers, or would the prudent guidelines from Fannie Mae and Freddie Mac mitigate that risk? If you are starting to realize how massive the implications might be, let us know you are enjoying this deep dive. Any sign of your support helps us bring more big-picture insights straight to you. Now, to truly appreciate the significance of this moment, consider the symbolic importance of the Federal Housing Finance Agency's approval. Fannie Mae and Freddie Mac do not just set mortgage standards. They are also the bellwethers for how credit risk is perceived nationwide. Once they open the gateway to counting cryptocurrency as mortgage assets, you can expect a ripple effect. Wall Street banks, community credit unions, and alternative lenders might find it easier to justify digital asset acceptance. Real estate agents could soon be marketing homes by saying, "Yes, we accept cryptocurrency-based reserves for your down payment." Contrarians say that conferring too much validity on a volatile asset might lead to shaky ground if and when digital coins experience a typical slump. But believers retort that the unstoppable momentum of blockchain technology is not going anywhere. Here is where we cannot forget the broader storyline. President Trump, once upon a time known for throwing scorn on digital coins, has pivoted to a near celebratory stance as the tides shifted under his feet. He signed an executive order that outlines a national strategy for building a robust digital asset ecosystem, culminating in that widely publicized plan to create the United States digital assets stockpile. Many see this as playing catch-up with other nations, but others interpret it as a genuine leap forward in financial independence. Somewhere in that transformative tapestry, a synergy formed between the White House and the Federal Housing Finance Agency leadership, paving the road for this directive. The synergy is exemplified by the $2.5 billion deal that Trump Media and Technology Group announced to create a Bitcoin treasury, solidifying the notion that top government figures see digital currencies as more than a passing obsession. And speaking of technology, the Vice President's presence at the Bitcoin 2025 conference spoke volumes. He hammered home the point that cryptocurrency stands for more than just wealth. It stands for personal freedom, a rallying cry that resonates with those who seek independence from big banks and corporate control of the financial system. But let us also address the potential pitfalls. Could this directive open the door to speculative mania in the housing market? Ever since the subprime crisis, regulators have been on high alert for anything that could trigger another bubble. Cryptocurrencies, with their capacity for giant price swings, might bring a further layer of complexity. Another aspect is the question of regulatory constraints. While the Federal Housing Finance Agency has authority over Fannie Mae and Freddie Mac, the broader acceptance of cryptocurrency for mortgage lending might be subject to state-level regulations or federal laws that revolve around anti-money laundering or investor protection. The entire system must align in order for this to work smoothly, and that alignment is no small feat. Additionally, the consumer mania that can accompany news of easy mortgages might lead to a repeat of frenzied speculation. The difference is that now, if a meltdown were to occur, it might be triggered by the unpredictability of digital currencies instead of the collapse of subprime adjustable rate mortgages. We must not forget that Fannie Mae and Freddie Mac, despite these new instructions, are still on the hook to produce a well-articulated plan. That plan might outline stringent checks to ensure that borrowers who pledge cryptocurrency as an asset have a thorough understanding of the risks. They might require that a certain portion of the digital asset be locked into escrow, or perhaps that it remains untouched for a given length of time. They could also set a minimum threshold for overall liquidity to ensure that a dip in cryptocurrency prices will not be the instant downfall of the borrower. Some industry insiders have even hinted that the directive could lead Fannie Mae and Freddie Mac to partner with reputable cryptocurrency custodians or stablecoin providers, thereby mitigating the liquidity and volatility concerns. We do not have all the details yet, but the wheels are definitely in motion, and the future of American mortgages could look dramatically different 5 years down the line. One has to wonder, though, whether all this is part of a larger plan to entrench the United States as the undisputed leader in finance technology. Rival countries have dabbled in creating their own digital currencies, encouraging widespread use of blockchain systems and attracting blockchain startups. If the United States wants not only to keep pace, but to surge ahead, major institutions like the Federal Housing Finance Agency and the government-sponsored enterprises are likely to be key players. By acknowledging cryptocurrency in the mortgage sphere, the country signals that it is open for innovation. That might bring a tidal wave of tech talent, entrepreneurial ventures, and cross-border investments looking to capitalize on a supportive regulatory environment. At the same time, the rest of the world is watching closely, waiting to see if the gamble pays off or if it leads to an economic tripwire that sets off the next crisis. Whether you sense roaring opportunity or quiet trepidation, it is hard to deny that we are witnessing a pivotal chapter in the intersection of digital finance and the traditional housing market. This is where we find ourselves at the crossroads. A housing ecosystem that has not changed its fundamental guidelines in decades is now breaking new ground, believing that the realm of cryptocurrency could become a legitimate ally instead of a threat. Will we see a surge of millennial and Gen Z homebuyers who could never quite fit the standard proof of reserves model but now can rely on their digital tokens to meet down payment thresholds? Will interest rates adjust to compensate for the higher volatility of these assets? Or will new insurance products spring up to cover any shortfalls in case of a crypto meltdown? As you can tell, the path forward is peppered with questions that do not yet have definitive answers, which is precisely why this story is so riveting to follow. One thing is certain: the Federal Housing Finance Agency has lit a fuse on an economic experiment that will be studied for decades. A union that once seemed impossible, the old-school mortgage world and the avant-garde domain of cryptocurrencies, is now being fashioned into an unexpected partnership. This is not just about being able to say, "I closed on my house with a dash of crypto." It is also about forging new directions in finance, shifting the power dynamics between lenders and borrowers, and possibly rewriting the very guidelines of asset valuation. With every major step, however, come big risks. Cyclical booms and busts could leave unwary borrowers adrift, and unscrupulous schemes might try to exploit the novelty of digital assets. If the Federal Housing Finance Agency, along with Fannie Mae and Freddie Mac, manages to establish robust, thoughtful structures, then we might see an era in which the dream of homeownership is more inclusive and future-forward than ever before. At this point, we have traversed a long and winding road, from the bruising memory of 2008 to the surprising stances of President Trump and Vice President J.D. Vance, who together have steered the White House toward a historically bold embrace of digital currency. We have explored the ramifications, both the bright promises and the dark pitfalls, of counting cryptocurrency as part of your mortgage reserves. The time is ripe to stay vigilant. Will the markets respond with an enthusiastic cheer, or will they recoil once reality sinks in about the practical challenges of verifying and liquidating digital assets during a major market rout? Only time will tell. If you want to remain in the loop for all future developments, especially if you are eyeing your own mortgage strategy, stay close, because we plan to track every twist and turn in this saga. That is our deep dive. We started with a thunderclap of a statement and journeyed through the complexities, the controversies, and the cutting-edge nature of the Federal Housing Finance Agency's directive to Fannie Mae and Freddie Mac. Never has the intersection of housing and cryptocurrency been this electric, and rarely has the potential for massive shifts in the financial landscape felt more tangible. If you, like many of us, are left astonished by the sheer scope of what might lie ahead, give yourself a moment to reflect on how quickly seemingly outlandish ideas can become tomorrow's standard practice. We have learned that in finance, as in life, the improbable can become inevitable almost overnight, especially when the right mixture of leadership, legislation, and consumer demand enters the picture. Get ready, because whether you are an investor, a home buyer, or just an observer of global economic trends, the mortgage world is set to change in ways we never thought possible.